I'm Noel Lateef, President of the Foreign Policy Association. And I'd like to welcome you to this joint meeting of the Foreign Policy Association and the Chartered Financial Analysts Society of New York. For the first time in 102 years, we have released a special edition of our annual briefing book, Great Decisions. An extraordinary roster of contributors have been assembled to take stock of the impact of the COVID-19 public health crisis and to look ahead. We are fortunate to have with us today two distinguished contributors to the special edition. They are William Rhodes, President and CEO of William Rhodes Global Advisors, former Citibank chairman, and one of the key architects of the debt restructuring efforts in Latin America during the 1990s. Bill is the author of an iconic memoir, Banker to the World. Paul Sheard is research fellow at the Harvard Kennedy School and formerly vice chairman of Standard & Poor's Global. A renowned economist, he is well known to this audience as a keen observer of the economies of the Pacific Rim with special emphasis on Japan. Gentlemen, welcome. Bill, when the world tilts back towards its accustomed axis, what lessons are there to be learned from this global pandemic? Why has there been so little international cooperation? More specifically, what's your appraisal of the G20 Summit last month?
Well, I think a couple of things came out of that. As usual, the emphasis is on the world economy. What was unusual was, number one, it was hosted by an Arab country for the first time. Saudi Arabia hosted it. Obviously, this was not done in a live session. It was all done virtually. But I think it was very important to note that. And I say that with all your interest in the Middle East. What came out of it was an emphasis on the impact of COVID on the world economy and what needed to be done on that. There were discussions on world trade, although nothing definitive was decided upon. Although I think there'll be more of an interest on the part of the United States with the incoming Biden administration on the WTO, World Trade Organization, which has been unfortunately not able to do what it should be doing over the last few months because of problems, among others, between the United States and China, and President Trump's feeling that it was not doing the job. Obviously, COVID-19 played a key role in what the discussions were. And what was agreed upon was what is now known as a common framework for debt restructuring for the poorer countries of the world. Having said that, it is not clear exactly what all the elements of that are going to be. At previous meetings of the G20 and the annual meeting of the IMF World Bank in October, there was an agreement, and earlier also at the beginning of COVID, meetings of the World Bank and the IMF and the G20 to put in place a standstill on debt for the poorer countries, known as DSSI. Originally, it was for a period till the end of this year. They've extended it in October till June, but people like David Malpass at the World Bank were lobbying very much for it to be extended for the full next year, 2021, but that was not agreed upon. So the question is, how will this new framework work? Because we have I would say, the most serious emerging market debt crisis that we faced in memory. Much more serious than the Latin American debt crisis or the Asian financial crisis of the late 90s. And so we have countries worldwide in the emerging markets. It's not one particular geographical area that is suffering. from the COVID-19 and unable to pay their debts. So what is necessary to make this new framework, or common framework as they call it, happen? And I think one is very much that we need a new special drawing rights approval by the major shareholders of the International Monetary Fund, starting with the US, to give them greater resources to lend to emerging market countries in trouble. Second of all, we are going to need the active involvement of the private sector, because the private sector holds a lot of this sovereign debt. In fact, the majority of it. So this is very, very important to have their involvement. And third of all, China is in a difficult position in the sense that it is a different position, because in the previous major debt crisis of the 1980s, early 90s in Latin America, and Asian financial crisis in the late 1990s, China wasn't a major creditor nation. Now it is one of the largest, if not the largest creditor nation. The Kiel Institute basically has given out their latest estimate on the debt that China has taken on as a creditor nation. And it's a staggering amount of something like $630 billion, mainly stemming from loans of the China Development Bank and the China Exim Bank through the One Belt, One Road plan of lending to emerging markets put forth by Xi Jinping at the time he entered as head of state. And the question is that what is China going to do with this debt? Because they are not a full member of the Paris Club, which normally restructures this debt by the major creditor nations. They are only an observer. And they have not been very transparent or forthcoming about what the terms of their debt arrangements are with these countries. And these countries are not just Southeast Asia, they cover Africa very heavily and also into Latin America. So without China's participation, this new common framework will not work. And I go back to the private sector again, because you need the private sector involvement, as we had in the Latin American debt crisis and the Asian financial crisis. So all of these have to happen if this common framework is going to work.
Thank you, Bill. Paul, to help set the scene for our discussion, where do you see the global economy currently in terms of the impact of COVID-19 and how far it has recovered?
Thanks, Noel. Well, first of all, let's sort of just make the point before we talk about where the global economy is, underscore just what a big shock, negative shock to economic activity this COVID-19 pandemic has been. You could look, for example, at the IMF forecasts, the World Economic Outlook that they put out, which many people take as a kind of benchmark for forecasts. In January of this year, the IMF was forecasting global growth of something like 3.3%. Not too bad, not that good, but 3.3. Now they're forecasting with the October revision minus 4.4. So that's a 7.7 percentage point downward revision for global growth in 2020. It's totally unprecedented. And this has been a big shock across the whole global economy. In terms of where we are now, if you look at the level of GDP, just real GDP, so compared where it was to fourth quarter last year, we have most of the Q3 numbers in at the moment. Most economies are about 3 to 4% below where they were at the end of last year, before the COVID shock really hit. In terms of sort of a V shape, if you look at the US, for example, I would say it's fair enough to characterize the recovery here as we've gone down a very, very sharp left-hand side of the V, and we're about one half of the ways up the right-hand side of the V, so about halfway there. But this, again, is such a unique economic event. You can't look at it just in terms of the level of GDP. There's also a lot of compositional change going on below the surface. And probably the most closely watched number in the US for sort of timeliness of how things are going is the weekly initial unemployment claims. And so I keep a close eye on them. And if you look at the cumulative initial unemployment claims, weekly numbers, cumulative from mid-March when this really took off, that number now stands at about 70 million. And that's about 42% of the February workforce in the United States. So while the unemployment rate in the US, which was 3.5% in February, went up to 14.7% by April, just in 2 months, is now down to 6.7%, I think it is. There's still enormous kind of problems in the labor market and kind of an underlying churn going on in the labor market. So in terms of, that's where we are now. In terms of the outlook, really it depends on two things, and most importantly, the course of the pandemic and how successful and how quick and how successful the rollout of the vaccines and therapeutics is. So that's the first thing. And of course, I'm an economist, not an epidemiologist. So if you tell me that there's going to be a resurgence, not just a second round, but maybe a mutation or a worsening or a diffusion of the virus, that is going to impact economic activity. But it's going to impact economic activity mainly through the way in which governments and policymakers respond to the crisis. Obviously, what people do autonomously is important, consumers and companies through their investment programs. But of course, do we go into lockdown, shutdown? Does international travel remain suppressed? That is going to be an important determinant of the economic recovery. But as a baseline, if it is the case that we've got through the worst of this, vaccines are on the way, they're actually being rolled out as we speak. First half of next year, there'll be a sort of a transition phase, but by the second half of next year, pretty much COVID-19 is receding into our collective memories. Touch wood, that's the outcome. Then, and I did just touch wood, then I think we're looking at a global economy that is getting back to somewhat of a normal state. But again, it's going to be, to use the hackneyed phrase, a new normal. But one thing that does worry me, and this speaks to Bill's area of expertise in emerging markets, is if we look at the way in which this virus is spread through the world, it's North America, it's Europe. It's not really East Asia. East Asia has been pretty much left off the hook in terms of the mortality and whatnot. Latin America has been badly affected, but Africa is not really, at least it's not showing up in the numbers at the moment. But take a country like India, which in PPP terms is the third largest economy in the world. The virus seemed to be slow to hit India, but now it's there. And GDP this year is forecast to fall by about 10%. So one thing that worries me a little bit in the back of my mind is, if this virus is still going to be sort of seeping its way through the global economy, particularly to emerging markets, then it will be a little bit early to crack the champagne open. And that does speak to the risk that Bill is highlighting of an emerging markets debt crisis.
Paul, if I could just follow up on the outlook, how do you see the global economy performing in the next 1 or 2 years?
Well, again, I think it's really a picture of, in terms of the baseline, a continued recovery. So if we look at what happened with COVID, China was hit in the first quarter, but by second quarter, it was recovering. And in fact, China is one of the few economies which, at the moment, GDP, the level of GDP is above the level pre-COVID already. The rest of the developed world, the Euro area, the US, UK, etc., really had a bad second quarter this year. But already by the end of the second quarter, the economy was recovering and had this very strong third quarter. But you have to be very careful in this kind of situation to look both at levels and growth rates, because you can get a very big growth rate off a very low base because you fell so far. But as we're in fourth quarter now, with the second wave hitting Europe and the US, and again, sort of people not going into total lockdown, but a little bit of a suppression of economic activity, Q4 looks like it's going to be a positive quarter on quarter, but much more moderate. And I think that pattern will probably be replicated a little bit in the first half of next year, a bit of patchiness, but growth should be relatively strong. And if we've got through the virus by mid-year next year with the vaccination program, one thing that economists like to talk about is pent-up demand. And there will be a lot of pent-up demand, particularly for, international travel, for holidays, for going, getting out and about again. All of the sectors that have been most hit: retail, entertainment, travel, hospitality, etc. So second half of next year, could potentially be a very strong sort of period, and then again carrying over into 2022, you're looking perhaps then at more normalization, getting back to something that resembles potential growth rate. So, I think in terms of the growth outlook, unless we get that sort of epidemiological, medical pandemic shock reasserting itself, I think it's a pretty positive outlook, particularly with all of the monetary and fiscal policy stimulus, which really has been injecting a lot of purchasing power, latent purchasing power. A lot of people have been hit badly, but there's a lot of money that's been injected into the system, which should support a consumer recovery, again, when the all clear is given.
Let me follow up on your appraisal of the policy response. And maybe I can ask Bill, it seems that central banks and governments have pulled out all the stops with monetary and fiscal policy. How do you assess the policy response?
Well, I think they are doing what is necessary for the moment. But one of the things we have to take into account, listening to what Paul has to say, is that central banks and on the fiscal side, governments have poured trillions of dollars into the markets because interest rates are so low in Europe, negative. But in general, you not have a tremendous amount of debt in the emerging markets, both sovereign and private sector. But also you're seeing this in the so-called developed world. And a lot of this was obviously necessary to get us through the COVID pandemic. The question is, when are we going to see the debt get to a height that it becomes a problem? That may not be immediately in the next year or two, but eventually some of this debt could cause us problems because there's been a lot of risk taking here with what we refer to as a search and reach for yields. In other words, people taking on risk that they normally wouldn't, even pension funds, to make sure they get the necessary returns. And historically, this has always come home to roost, although it may take several years to do so. I'd be interested in Paul's thoughts on that.
Yes, I'm a little bit, I'm much more relaxed about the debt situation in the developed world. The countries where you essentially have, monetary sovereignty, even though we have independent central banks. I think it is what we've seen as the central banks and the governments, the treasuries, working closely together. And essentially what's happened in the world, and of course this is sort of in some sense the financial crisis of 2008 and 2009, with central banks going to zero interest rate policy, and then of course massive large-scale quantitative easing, a lot of fiscal red ink being spilled, and we never really normalized from that. And here we are 10 years later, being hit with what actually in size-wise is a bigger economic shock to aggregate demand. Central banks and fiscal authorities really were able to dust off the 2008-2009 playbook and put it to work very, very quickly, and I think quite effectively. But I think we have a situation really where there's something else that's going on, which I think is really more of a multi-year, almost multi-decade phenomenon, which is the macroeconomic policy framework, that is monetary policy and fiscal policy. How those two things, the respective role of those two sort of key areas of aggregate demand management, and how they interrelate, how they relate together, is, I think, undergoing an evolution. And in broad brush terms, the 20th century, and particularly maybe the second half of the 20th century, was really all about learning the lessons that if governments had unfettered access to their own printing press, then you could get runaway inflation, and that would be very bad for economies. And so the institution of the independent sort of technocratic central bank that was isolated from political influence and given the main responsibility for managing the macroeconomy. That framework developed and was refined and worked very, very well. But I cut my teeth as a markets economist or as an economist in Japan. I had a front row seat on the 1990s bursting of the bubble in Japan and what the Bank of Japan did with its monetary policy. And so I think beginning with Japan, then we've seen the global financial crisis, and then we had the sovereign debt crisis in Europe, and now we're having COVID. And I think what we're all collectively learning is that there's another set of circumstances where the idea of an independent central bank having the responsibility for the macroeconomy no longer works so well. We need monetary and fiscal coming together. And some of the institutional framework, some of the thinking that we had, and some of the protocols we had around solving the too high inflation problem don't actually get in the way when we have a situation of too little inflation, too little aggregate demand, and maybe a very, very low interest rates. This debate about secular stagnation, as Larry Summers calls it, or low R star, where really monetary policy loses much of its effectiveness. So I think while there will be debates about how do we get fiscal finances back on a more sustainable looking path, I think we're going to come out of this event really with some lessons about maybe permanently reshaping the macroeconomic policy framework. So we don't throw the baby out with the bathwater. We don't give up the fact that central banks were very successful in controlling inflation, but also we learn how to pivot to a situation where the monetary and the fiscal can work hand in hand to really minimize the damage from this new environment that we seem to be finding ourselves with increasing frequency.
Paul, on the fiscal policy front, how concerned should we be about governments running such large budget deficits and the sharply rising government debt levels and debt to GDP ratios?
Yeah, so continuing on from my comments there, Noel, I'm different people worry about this to different degrees. I'm not really particularly worried about that. I think, as Bill was pointing out, those policy responses were definitely needed. I have more of a bit of a fan of Abba Lerner, one of, I think, the underappreciated economists of the 20th century. He was a younger contemporary of Keynes, brilliant economist who made contributions to a number of areas. One of his contributions was the idea of functional finance, the idea that essentially monetary and fiscal policy, we need to think of them as being in the service of getting good economic outcomes, that is full employment, price stability, fiscal financial stability, rather that. So in other words, the fiscal metrics that we tend to focus on a lot, really we need to look at as means towards an end, not the end in themselves. And I think as that those lessons I talked about before of the 20th century became codified in intellectual and operational frameworks, and we started to get sort of central bank tribes and fiscal tribes and different academic tribes developing, I think sometimes the tail was wagging the dog a little bit. And so I think we just have to look forward. And if we get to the point where we do need to rein in debt levels, or let's say inflation starts to pick up, that will be, I think, a good thing. It'll be a sign of success. But policymakers, whether it's monetary policymakers with interest rates and their balance sheets, or fiscal policymakers, if they can maintain their political discipline with taxes and expenditure, we have all the tools at our disposal. Policymakers, that is, society, has the tools at its disposal to deal with problems that might arise down the track when the current period the problems have been solved. But worrying about rising debt levels when we still have unemployment at elevated levels, and I said 6.7% for the US compared to 3.5% in February. But a lot of those jobs are low quality, part-time jobs, and by no means are we anywhere near yet a booming labor market in the US or anywhere for that matter. And that really matters for people's welfare. High unemployment is damaging not just to current workers, it influences society more generally with all the ancillary problems, and is a permanent drag, or stands to be a permanent drag on future economic growth as well, because workers lose their attachment to the labor market, their skills depreciate. So I'm very happy that policymakers at the moment and for the foreseeable future seem to be going all in on very supportive monetary and fiscal policy. And I think that's in due course will be shown to, history will show that was the right approach.
I would just like to make some comments. I think that Paul and I agree that short term, what's been done was absolutely necessary. In fact, you could say maybe more should have been done in some areas than was done. I'm talking a little further out, because you have people comparing what's going to come in the next few years as a sort of a restart of the Roaring '20s when we came out of the Spanish flu after World War I. Of course, the difference there was that we had a combination of coming out of a major war and the end of the Spanish flu, which took 3 years to get rid of. And of course, that would be like coming out of World War II and coming out of COVID. So I think short term, what's being done is absolutely necessary and will be so, as Paul says, over the next few years. I am just saying over time, we have to be careful about the point you raised, Noel, about the debt levels. And of course, Paul mentioned his favorite economist. Well, I have one too, and his name is Chaim Minsky. And he happened to be a professor at Brown of economics when I went there. And of course, Chaim Minsky is known for the so-called Minsky moment, when things are allowed to get out of hand and not dealt with. And I'm just saying that I think a longer term view here would be prudent to make sure we don't allow these debt levels to get out of hand going forward, because it's always wise to be careful on this. Having been a disciple and a close friend, and we shared offices with Paul Volcker, I heard this every day. Now, Paul faced a different situation with taming the great dragon of inflation in the early 1980s, and the situation's completely different today. But he always warned me that when things are really rolling along, coming out of a problem, people tend to forget that you've got to watch debt levels if they get too large, and particularly search and reach for yield over time tends to cause market corrections, which is what Chaim Minsky basically put forth in his so-called Minsky moment view.
Can I say, Noel? I would second Bill's enema of Hyman Minsky. He's perhaps number 2 on my list. I've got Minsky, Lerner. I've got Keynes. I like a bit of Friedman. I like Hayek. I think all these economists, these great economists, have all brought some very important insights to the table. I think what I think we need to do, some of the the sort of perhaps the people not so much at the policy front line, but maybe someone in the academic community as well, as we come out of this, apropos of the warning that Bill's giving, give some serious thought to how do we need to codify these cumulative learnings that we're getting as we move through history in the institutional framework, so that we add to collective human wisdom rather than do something reactive and that solves one problem, but just sort of undoes the wisdom that we've learned in the past. And to give a plug for your great decisions document, a publication, Noel, that's kind of the subject of my essay in that compendium.
Yes, thank you very much for flagging that, Paul. Let me ask a geopolitical question. Gentlemen, what do you think a Biden administration means for restoring America's leadership in the world and in the global economy?
Well, I would just start and then pass it on to Paul. I think one of the things that Biden's already stated he's going to do, he's going to get the new administration re-involved, I think, on very important international areas. We had mentioned before the World Health Organization. I think it was a major mistake to pull out of the World Health Organization because I think it's absolutely necessary to be part of it. if we don't agree with policies, for instance, a policy of waiting too long with China to declare it was a pandemic because of the influence of China, particularly in the nomination of the present head of the WHO. But that doesn't mean you pull out. And that's the same with the World Trade Organization. The World Trade Organization actually was an idea that the United States supported very much in its founding. And I think we have to be active in there to protect our interests, not just pull our people out and criticize in both of these organizations. I think also an area which we haven't touched on is climate. And I think we are in a climate crisis in the world today. And although there are many loopholes that could be fixed in the Paris Agreement, I think we have to rejoin that without a doubt as soon as possible. I think the Biden administration, and particularly Janet Yellen, is a great believer in green finance, which is to really get out there and push financial institutions and the market to finance green initiatives. In fact, she co-chaired a paper by the Group of 30 with Mark Carney that came out a few months ago on this particular subject. So I think we're going to see much more emphasis on climate and how to finance the needed changes in climate with green finance than we've seen before. I think another one, which is right up front, is the whole attitude towards NATO and the Atlantic Alliance, because no one, I think, would criticize Trump for wanting to get the Europeans to pay more of the bill for the troops that we have to keep in Europe and for our military, which helps keep Russia at bay, among others. And so, whereas that initiative was positive to get him to do more, to basically give the impression that he was going to pull out of NATO and constantly criticize them, I think was a mistake. So I think you'll see a reinforcement of the Atlantic Alliance, which I think is absolutely necessary. And Biden has been, and his new Secretary of State have been great believers in the Atlantic Alliance. And I think it's not only important with regards to the United States and Europe, but I think we need a common front with regards to China. And instead of doing it on our own, we basically should be working with our partners in the democracies of Europe.
Could I follow up on that, Bill? In terms of, do you think there's going to be significant divergence on US-China relations between these administrations?
If you track what Biden has been saying over the last couple of years and the support of labor that he's counting on, the answer is no immediately. I think what you're going to have is a more rational policy in how to deal with China rather than threatening them one day, to try and get a better trade deal, and to try and do so on a more organized basis, working with our European allies. Because we have to face facts that China is not only the world's second largest economy today, it's no longer Japan as it was 20, 30 years ago, but also it is the fastest growing of the G20 economies. And you have to be able to deal with them, not just on an economic basis, but on a strategic and military basis, because they've grown their military to the size where in some areas, they are just as potent as US military. And we see their efforts in the South China Sea to expand their influence. We also see it through their efforts in Pakistan, which is one of the reasons why India, and Paul mentioned India before, about the severe hit COVID's having there of some estimated 10% negative GDP when they're used to having 10% positive GDP. But I think India is very concerned about the incursions on their border, with China. And so we're seeing this all over. And Paul, you would be the one to talk about the feelings in Japan about China, not just economically, but also very importantly, strategically and militarily. And then you go to the influence that China has over North Korea. And we fought a war there. People forget the Korean War. I was just a kid at the time, but it certainly impressed me. And the Koreans depend on our military support, just like Japan does. So when we look at China, we're not just looking at an economic powerhouse that's the fastest growing of all the major world economies in the sense of developed economies, although they say they're developing, but we all know they basically meet the test of a developed economy, but also the military and strategic side that goes along with that. So Paul, I'd be very interested in your thoughts as a Japan expert, how you see Japan in all of this, both economically, financially, strategically, and militarily.
Thanks very much, Bill. And perhaps just before I get to Japan, just to pick up on Noel's point and frame this a little bit. And it's so easy for these discussions of when we talk about the Biden administration, the Trump administration, there's so much partisanship and so much emotion, and so much gets kind of hijacked by that side of things. What I try to do as an analyst is try to understand, see through the fog, the noise, of what's going on beneath the surface. And so, when I heard, the President Trump's kind of slogans back in 2016 of "Make America Great Again, America First," and then of course we had "Drain the Swamp," I tried to think, what's going on here? What does this mean? What's driving this? And I think what was driving it was sort of what Bill has been referring to, particularly with the rise of China, is that, big picture, there's been a big turning point. It took years to develop, but let's call it the end of Pax Americana, the end of this era of post-war period where the US was both willing and able to be the kind of benign hegemon. I mean, some people might take issue with how benign it was, but let's take that as granted. That, in other words, the sort of the underwriter of global security, and also the underwriter of the liberal international order, opening its markets to emerging markets, to Japan, Germany in the 1950s and 60s when they were recovering. And I think we'd reached the point where the US was no longer really either willing or able to fulfill that role. And when I hear America First, and maybe I'm naive here, but some people hear America alone or America isolating itself. But I chose to interpret it more as reflecting the point that America is becoming perhaps a little bit more like a normal nation that is putting its own national interests first. I think that's the first lesson of political science or international relations, that all countries put their own national self-interest first, but on top of that, then seek ways to build a common international good. So I think with the rise of China and with the US now saying we have to divert more resources perhaps to our domestic infrastructure, education system, and so on, that what is really desperately needed is a kind of a new, I hesitate to call it new global world order, but a new set of sort of institutions and frameworks and approaches which accommodate the rise of China, to a certain extent hold China also accountable for now being one of the two by far largest economies, and probably set over the next couple of decades to become the dominant economy in the world. How do we make the world actually function in that environment, not just giving China a seat at the table, but essentially holding China accountable to meet its responsibilities as the first or second largest economy in the world alongside the US. So I think getting back to the Biden administration, that underlying reality has not changed. So I don't think we're going back to a kind of pre-Trumpian world. But as Bill has intimated, and as we've already seen, the Biden administration will engage much more in a much more sort of friendly sounding, less adversarial, less isolationist sounding way with the rest of the world through engagement with the different institutional institutions. But I think it has to go beyond that, to asking serious questions about how do we accommodate this rise of China and the East and the West? Now that brings me, I guess, to Japan, because geographically Japan sits right on the edge of the Korean Peninsula and China, not too far away. It's locationally part of East Asia, but geopolitically it's really part of the Western alliance. It has a security alliance with with the United States, as a number of countries do. NATO, of course, but also Australia has its own alliance. So I think Japan, stands to play potentially an important role, again, taking up some of that leadership slack as the US pulls back a little bit and focuses a little bit more on its own internal affairs. But, a middle power, or, it's the third largest economy in the world, or fourth largest, depending on how you measure it. I do think the Japanese economy is not in anywhere near as bad shape as perhaps some of the headlines and the sort of metaphor of Japan's lost decades would indicate. It has a lot of strength. And I think it's interesting, when the US pulled out of TPP, one of the first things that the US did under the Trump administration, of course, Japan, to many people's surprise, joined forces with the US, with Australia in particular, to really push that concept forward, and it did survive as a CPTPP. Now we'll have to see whether the US administration comes back into that or some other regional trading arrangement under the Biden administration. But I think Japan, is a country that geopolitically punches below its weight, and I do think that over the next few years, again, with these changing geopolitical and geoeconomic dynamics, it can, and I think should, step up to the plate a little bit more and play a positive role. And, they have got a window into China that, the rest of the world, sitting here with Bill and Noel, we're all on the East Coast of the US. China feels like miles away when you sit here. Obviously, China experts focus on it, but it's not front and center of people's consciousness in the way that it is if you're sitting in Japan and you have, 2,000 or 3,000 years of history of dealing with China. So there's an opportunity for Japan to play more of a kind of an intermediary kind of interpretative role. China will see it as very much part of the US-centered Western alliance, but I think it can manage that balancing act, and I think that could help. Again, that more positive vision that I have of accommodating China and getting to a better, let's call it, equilibrium in the nature of international geopolitical, economic, security, climate change, whatever, cooperation.
Paul, I can't resist asking you, is it a case of where Japan goes, the rest of the world follows in due course?
A quick answer, I think it probably is, Noel. And I think you're referring to this question of Japanization. This has been asked for a long time, but, I was in Japan, I lived there for 17 years, but particularly 1993 to 2006. And at that point, Japan was having its banking crisis, deflation, and then you had the Bank of Japan doing all sorts of whiz-bang stuff like zero interest rate policy and quantitative easing. They even did some credit easing. They really pioneered in the modern era forward guidance. These are all familiar tools now in the toolkits of central banks. Under Governor Kuroda, they've gone to yield curve control, where they target not just the overnight rate at minus 10 basis points, but the 10-year JGB rate, the equivalent of the Treasury rate, at around about zero. And I think that's a framework that the Fed and other central banks have looked closely at. And the Reserve Bank of Australia, my native land, when they went into their QE this year, they dodged that bullet in the 2008-9 financial crisis. They've gone into QE and close to zero interest rate policies. They're now implementing a form of yield curve control. So I think when looking back on Japan, it wasn't just about their banking crisis and everything else that went with that, which I think was mismanaged, frankly. But also, I think Japan was the first economy that was going into this secular stagnation. Alvin Hansen from the 1930s, another economist, introduced that idea. Larry Summers resurrected it, I think, in 2013. But this idea that the real rate of interest is now very, very low, maybe close to zero. That means that central banks have much less monetary ammunition. So maybe Japan in the 1990s and 2000s was really the first developed world economy that was showing that is a broader trend. Now, what could be driving that? I think there's a lot of things, but one of the other dimensions upon which Japan is at the cutting edge, of course, is the aging of society and the demographic trends that are going on. So perhaps along with Italy and a couple of others, Japan is confronting the challenges of an aging society ahead of others. So I think, again, Japan has gone off the radar screen, but I'm quite positive about a number of dimensions of Japan. One of them is around corporate governance, perhaps a different topic, but ESG and sort of corporate social responsibility are big topics now in the West. We had the Business Roundtable statement that came out August of last year saying the purpose of the corporation is not just to pursue profits, a la Milton Friedman, another great economist, but to take a much broader sort of view of its social responsibilities. Well, the Japanese corporation historically has been criticized by many in the West for having precisely that kind of model. So their corporate governance has moved towards the Western model, but the Western model itself seems to be coming back somewhat towards the Japanese model, maybe meeting in the middle. So I think there are a lot of lessons to be learned from Japan, but perhaps Japan needs to sort of communicate a little bit more proactively. They tend to be a little bit too modest about their own assets and their strengths. So I'll do it on their behalf here today.
Thank you.
Noel, just a couple of comments on what Paul was saying. I agree with him on Japan needing to take a more important role in Asia. And I think one of the things I've seen in Japan, when I started to work with Japan 40 years ago, the MOF was all that really counted on the economic side. Of course, in the last few years, we've seen Shirakawa and we've seen Kuroda, et cetera. And suddenly the Bank of Japan became the primary element, particularly with all the things that Paul's described of what they went through with the banking crisis, et cetera. But one of the interesting things going back to Biden is that he's talking about, which I think would be very important depending on who he gives a job to and what authority, an Asian czar. Because although Trump supposedly had good relations with Australia and Japan and Korea, we didn't have much, and India, we didn't have much of a framework in the sense of an organized framework. And I think that we have to understand that Asia is the fastest growing part of the world. And we have to keep that in mind. So our relationships with Australia, India, Southeast Asia, Japan and Korea are key. And we've seen Vladimir Putin taking much more interest in the Far East than we've seen in quite some time, whether it be with Korea, this new love affair, which we've seen between Putin and Xi Jinping, et cetera. So I think it's very important for the Biden administration to really put a lot of emphasis, not just on the Atlantic Alliance, but our relationships in Asia, the fastest growing part of the world, and countries like Australia, Japan, parts of Southeast Asia, certainly Korea and India, are really looking for the United States to show that it still can be a leader. I think we made a mistake with TPP. I think it was the right thing to do. And as Paul mentioned, Japan and the Australians and the others went ahead with their version of it. I'm not saying we should jump in and rejoin it, but it's something we really ought to take a look at. So I really think this administration has got to have an organized strategy with Asia. And if we don't, the Chinese will take very much advantage of us in all ways. So these would be my comments vis-a-vis Asia.
Bill, you've dealt extensively with Mexico. Do you think there is, as you just said, as the world moves increasingly in the direction of trading blocs, such as the recent regional comprehensive economic partnership among the Asia Pacific nations, do you think there is merit in having more cooperation in North America and perhaps coming up with a North American competitiveness strategy?
Well, I would go one step further. I was a big supporter with George Bush Sr. and also at the beginning of the Clinton administration with a hemispheric trade pact. And of course, that fell completely apart. But I think now what you have is you have the latest version of NAFTA for North America. You have Mercosur for Brazil, Argentina, etc. And you have the Pacific Alliance, which is Pacific, Peru, Colombia, Mexico, etc. And I think that Chile, I think it's very important in Latin America that you kind of merge Mercosur and the Pacific Alliance because there's so much in common there. And going on from there, being the hopeful idealist on trade that I am, I would hope at some point we could put that together as George Bush Sr. had in mind and have sort of a North American kind of trade bloc. We'll see if that ever happens. But certainly Mexico is key to us for so many reasons, not only as a member of our trade pact, but also with the question of immigration, the question of crime, drugs, etc., and what's going on in Central America. What we really should have in Central America is some sort of a Marshall Plan put together by the United States and Mexico to try and solve some of the problems in Central America. Because if you take a look at where the immigration is coming from, the majority of immigration is no longer coming from Mexico with Mexicans, it's Central Americans. And we have done very little in that area, I think, to solve the problem. So we do have this problem, and I would hope that the Biden administration would put forth some program working with Mexico along the lines that I've suggested.
Bill, you've sought to bring attention to the economic deterioration in Venezuela. How bad is it?
It's pretty bad. I was fortunate to live in Venezuela during the golden age, 13 years on and off. And at that point, Venezuela, along with Argentina, had the best health systems in Latin America. It was the wealthiest economy in the hemisphere. And it had everything going for it. And what happened is you had, as you do in a number of these countries, you had a lot of corruption. And unfortunately, Chavez took advantage of that. And we have his successor, Maduro, running what amounts to a police state with the support of Cuba with a secret police. All units of intelligence and secret police are run by Cubans at this particular point in time. You have Russian advisors and Iranian advisors with the military. And this is a state that is rotten to the core with corruption on drugs and whatever else you can think of. Also, it's the greatest human tragedy that we've seen in modern history in Latin America, with 5 million refugees having to leave this country and being forced to go elsewhere in Latin America. And of course, this situation was bad enough before COVID. But once COVID hit, a lot of these countries just couldn't maintain the support they have of the Venezuelan refugees, and some of them being forced to go back. I mean, in the case of Colombia, you had up to 1.5 million, and still it could be 1.5 million Venezuelan refugees there. And Colombia has its own economic problems with COVID. You have big concentrations in Ecuador, Peru, Chile, even Argentina. And in the north, in the state of Roraima, refugees are coming right through Guyana down into Roraima in Brazil. So for me, it's a particularly difficult human tragedy. And we've had an on-again, off-again policy of what we want to do there. And they just recently had an election. Was it 72 hours ago? I guess it is now, somewhat pretty close to that. The results came out. And of course, it wasn't an honest election. They asked Chavez asked the EU to observe it, but they wouldn't do it because they knew it was not going to be honest. And the major opposition, Guaido, didn't want to participate in it because he knew that it was already fixed. He and Leopoldo Lopez, who was one of the other major leaders of the opposition, and they took control of the National Assembly there, which was the only entity which basically had had an honest election some years ago. So the situation is very, very difficult. And since we're talking about China so much here, the biggest creditor nation at this particular point in time of Venezuela is China. And if you take a look at the statistics that have just come out on the One Belt, One Road, which I had referred to earlier, the largest recipient is Venezuela. Most people thought it was Pakistan, which is the second largest. So you have major Chinese influence there. I think when you talk to the Chinese, they just want to get repaid, which they're trying to do through oil swaps and everything. They don't have a political agenda per se in Venezuela, where there's no doubt the Cubans, the Russians, and the Iranians do. Very sad situation.
Very sad. Paul, following up on what Bill just said, is China likely to be the epicenter of an emerging markets debt crisis?
Well, that's a difficult call. I think one thing for sure. Two comments I'd make quickly. One is that, if China does have a major credit event, some kind of meltdown of their financial system, then we're talking about the mother of all emerging markets crises. China is such a big economy, so we can't line these up and put all the other emerging markets on the same pedestal as China. It would be of a different order of magnitude were it to occur. The second thing, just harking back to Hyman Minsky, that Bill quoted before, of course, is that if you look at history, every major country and probably minor countries, they all have their financial crisis at some point. Japan has had it, the US has had it, Australia had it. Everyone has it. It's it's almost kind of built into human psychology that you will get this irrational exuberance, and this time is different, or this country is different kind of issue. Now, one thing that's a little bit sort of worrying about China from that perspective is that China hasn't had its major financial disruption or crisis or collapse kind of yet. So is it going to happen at some point? It would seem that it's bound to happen at some point. The question is how soon, how severe, and how is it handled? But as a caution against that is, and I'll sort of defer to Bill on the kind of putting any probabilities on this and his prognosis. But the story that China was going to have some kind of meltdown has been around for a long time now. A lot of people thought it was the crisis in the early 2000s would be in China, not in the West. And they've managed to develop an economic system, a kind of a mixed economy where there's a certain amount of market energy and entrepreneurism, but there's a very, very heavy and controlling hand of the government through the financial system, through the SOEs, etc. So they've balanced things pretty well so far. They also, like Japan, although Japan did have a financial crisis, they do have a current account surplus, or they've had a current account surplus for a long time. So it's not as if they need to draw on the rest of the world's net savings in order to develop their own economy. They've plied a different path there. So, when I look at the metrics recently, that we don't seem to see, unless I'm missing it, a sudden buildup in debt the way that we saw around the financial crisis back in 2008, 2009. But so I don't see anything sort of imminent here. But if you were going to worry about an emerging market crisis, you went through your checklist, I think you should always put China at the top of the list and get some comfort there before you move on to the others.
Thank you.
I would just comment on that. I think that the last real financial crisis that China had was under Jiang Zemin as president and Zhu Rongji, who was probably the leading premier of China in its modern history, having been a graduate of running the People's Bank of China, the central bank, and also being mayor of Shanghai, which was the city of importance in the opening up of the economy of China. And when he saw it coming, what he did was, particularly in the banking system, because the banking system got into deep trouble in China. So what he did was he invited foreign companies to take a piece of the major Chinese banks, obviously a minority, to get their infusion, and also set up what's known as the asset management companies to buy off the bad debt to sell it in the markets. And he reorganized the banking system completely. And I say that he was the greatest in the sense of, in addition to having averted a major bust up in the economy of China at that time, he also was shrewd enough to get China into the WTO on the terms that China wanted. Now, they weren't exactly the terms that the US should have asked for, but they were the terms that suited China. So that is the last time that we've had a problem. We've seen a problem in China. But building on what Paul's saying, they have a lot of debt to GDP, between 300–400%. They've been carrying a lot of SOEs that really are not profitable. And they've recently had a lot of problems in their bond markets with some of the provincial and municipal entities not being able to meet their bond payments. And one of the real questions is, what is China going to do? Are they going to bail them out or just let them go under? Unfortunately, in China, you have a very fine central bank. For a number of recent years, it was run by It was run by Wan Qishan, who was who's now the vice president, but was the very much a leading light there. And what you have is Zhou Xiaochuan had ran it for a record amount of time, who was basically a person who was put in there by Zhu Rongji and Wan Qishan, who, as I said, Wan Qishan is now the vice president of China. And Yi Gang, the present head of the People's Bank of China, was actually trained and was a professor at the University of Indiana. So they are very fortunate to have first-rate economic technicians in China who are very concerned with the very things that we're talking about. So if you talk to them, and I do from time to time, although virtually these days, before it was personally, they will tell you that they do have a concern on this, which is good, because you can't resolve a problem unless you're concerned about it. But I agree with Paul's statement that at some particular point in time, something could trigger a problem. So it's something that has to be looked at carefully, although it's not an immediate danger. This tremendous buildup of debt and some of the defaults you're seeing in the markets are certainly not a positive sign.
Bill, I think we're going to give you the last word there. Bill Rhodes, Paul Sheard, thank you for sharing your insights with us today. I want to commend you both for your many contributions to global policy making. I'm Noel Lateef, signing off for the Global Policymakers series.